Have you ever taken a perfect trade setup but only to get stopped out and then the market flies in your favorable direction? You think the market is watching you. In a way, it is, but not the way you think. So in today's video, I'm going to reveal the secret and I'll also give you a solution to this problem. Now, I'm going to explain the concept of liquidity with an easy to understand illustration. Now, let's imagine there is a high-rise building, and in the morning hours, there are many people who are willing to go to their respective floors because their offices are at higher floors. Now, because there are only 2 elevators in the building, so the option is only for limited people to enter into the lift, and the capacity of the lift is 10 people at a time. Now, this is exactly the problem of liquidity when it comes to trading. So many traders, they want to enter into a buy trade at a specific level. Now, it is not possible for each and every trader to enter into the buy trade. So what happens? The stronger ones, they are able to occupy the lift and they will not allow the weaker ones to enter into the lift. And somehow, if a weaker person enters into the lift, they'll be pushed out. They will be pushed outside, and the stronger ones, they will take the opportunity and they will ride the lift. Now, exactly similar happens in the trade. So if a weaker trader, a weaker trader means a comparatively with lesser amount of money. So basically a retail trader, if they enter into the trade at a specific level, now the institutional traders who are the stronger ones, they will kick you out by hitting your stop loss, and then they will take the opportunity to ride the wave. So exactly what happens in the elevator example. So this is the problem of liquidity. Nobody is personally watching your trades, but smart money knows where the crowd hides. Now, most traders, they put the stop loss either above the obvious resistance or below the obvious support. Now here, the smart money, they know that most of the stop losses are placed at the particular level, or sometimes you place the stop loss at the obvious round numbers, and this is exact where the institutions, they trigger the liquidity grabs. Now let me explain why this happens. Because the institutions, the big players, they need liquidity. Market runs on liquidity. They need big volume to enter into the trades, and they know the obvious stop loss levels where most of the retail traders like you and me, we put our stop loss. So it is very easy for them to hunt the stop losses, and then the market moves in your direction. So your stop loss is not being hunted personally, but the institutions, they know where the herd is sitting with the bulk of stop losses, and that's the reason it's very easy for them to slaughter or hit your stop loss. Now, the $1 million question, how to fix this problem? There are multiple solutions, but in today's video, I'm going to show you one mechanism, one method which you can apply, and your problem would be fixed. So now I will explain how to protect your stop loss, or how to correctly apply your stop loss. And the solution is very simple. Now, most of the retail traders, when they open a sell trade, they generally put the stop loss exactly on the high. So they think this is a resistance level, and they apply the stop loss exactly on the high or slightly closer to the high. And when they apply for a buy trade, they think that we have a very good support here, and this is the perfect place to apply the stop loss. So this is the support. So either they will put the stop loss exactly on the support or very close to the support. Now, the solution here is very simple. So on TradingView or most of the other charting platforms, we have an indicator which is called ATR. Now, ATR stands for average true range, and it will give you a specific number. You just need to apply one thing. So you need to check the ATR value. So let's say we are trading gold, and the ATR value on whatever time frame you are trading, let's say it is $5. So what you need to do here, instead of applying stop loss very close to the high or low, you just need to apply the multiplication of 1.5x of ATR. So 1.5x into 5 in our current example. So your stop loss should be $7.50 higher than the resistance or lower than the support. So let's say if you're selling at 3300, this is the resistance, and here the buying is 3250. So now my stop loss will be 3307.5. So 3307 So my stop loss has to be higher. How much higher? It has to be adequately distant from the resistance. So here I've taken my stop loss as 3307.5 and I've added $7.5 because $7.5 is the 1.5x of 5, which is the ATR value coming from the indicator. Or if you're buying, your stop loss has to be $7.5 lower than 3250. So it should be 3242.5. Simple. Now let's go to the trading view chart and see the magical formula of ATR to protect our stop loss. Now, instead of red line, which is the obvious level where most of the retail traders they applied the stop loss, I would have taken the ATR value. So how do I get the ATR value? You just go to indicators, you look for ATR, that's it. And let's say I was trading on a 15 minutes chart. So here I would have taken a sell trade and the ATR is 4.27. I'll just round it off to 4 and 1.5 times of 4 is $6. So I would have kept my stop loss $6 higher than the highest price here. So the highest price is 3344. So instead of 3344, I would have applied my stop loss at 3350. So this should be at 3350. Now, had it been 3350, we would have safely reached to the take profit without hitting the stop loss. So our stop loss should be adequately distant either from the resistance or from the support, depending on the direction you want to take the trade. Now, a quick recap. Now, your stop losses are being hunted because they are at the most predictable price level. So the professional traders, they do not apply the stop losses at the most predictable levels where retail traders are placing the stop losses. So the simple solution is I've given you in today's video. We will apply the new technique and you will see that now you are not being slaughtered or your stop loss are not being hunted. So the common problem, once your stop loss gets hit, you think stop loss is the biggest problem. And many retail traders, they stop using the stop loss mechanism. They think it is the one of the biggest problem. No, in fact, stop loss is the best solution to protect your capital. The only thing is you need to apply it correctly. I hope my today's video added some value to your trading journey. And as a part of my weekly educational series, I'll be recording more videos and I'll be coming up with my weekly educational content. I would like to listen to your thoughts. Now, what are the common pain points and on which topics you want me to prepare new videos on? And also, if you want to take part in my classroom training, so we have our trading academy in Dubai, which is fully regulated by KHDA. You can visit my website www.moneytize.ae for more details. And do not forget to subscribe to my YouTube channel. And if you like my video, give it a thumbs up.